Welcome back. Today, we're diving into The Little Book of Common Sense Investing by John C. Bogle, the founder of Vanguard. Bogle's philosophy is all about simplicity, low costs, and long-term thinking. Let's break down the key takeaways from this must-read book. Let's kick things off by diving into a concept that has revolutionized the investment world. We're talking about what John Bogle is famous for: index funds. Bogle believed that trying to beat the market is a fool's game, a sentiment that resonates with many investors today. Index funds passively track a specific market index, like the S&P 500, allowing you to invest in a broad spectrum of the market. This means diversifying your investments across hundreds, sometimes thousands of stocks, which reduces risk. No need to spend hours researching individual companies. The index fund does the heavy lifting for you, simplifying your investment strategy. And the best part? Index funds have low costs, meaning more money stays in your pocket, rather than going to high management fees. Over time, these savings can significantly boost your returns, helping you build wealth steadily and securely. Whether you're saving for retirement, a child's education, or a dream vacation, index funds can be a powerful tool in your financial arsenal. So consider adding index funds to your investment strategy and watch your wealth grow with minimal effort. Let's talk about fees. Fees are an often overlooked aspect of investing, but they play a crucial role in determining your financial future. Investment fees can destroy your returns over time. Even a seemingly small fee can have a significant impact on your overall returns, especially when compounded over many years. Every dollar you pay in fees is a dollar not working for you. This means less money growing and compounding in your investment account, which can drastically affect your long-term financial goals. Over time, those small drips can drain your account. Imagine a slow leak in a bucket. Eventually, the bucket will be empty if the leak isn't fixed. The same goes for your investment account. For example, a 2% annual fee can cost you hundreds of thousands of dollars over 30 years. This is money that could have been growing and compounding, significantly boosting your retirement savings. Bogle advocated for index funds because their low fees mean more of your money stays invested. Index funds typically have lower fees compared to actively managed funds, making them a more cost-effective option for long-term investors. Remember, time is your greatest ally in investing, but fees are your biggest enemy. The longer you invest, the more your money can grow, but high fees can erode those gains. Be mindful of the fees you are paying and choose investments that align with your financial goals. Let's talk about the eighth wonder of the world: compound interest. Compounding is like a snowball effect on your money. It's about earning returns on your returns. The longer you let your money compound, the more powerful the effect becomes. Starting early is crucial. Even small investments can grow significantly over time. Time is your best friend when it comes to compounding. Investing isn't always smooth. The market can be scary with its ups and downs. Trying to time the market is basically impossible. Bogle's advice: tune out the noise and focus on the long game. Short-term market swings are just bumps in the road. Instead of panicking, think of market dips as sales on your favorite stocks. The market has always recovered from downturns in the past. Diversification is key to managing risk. If you invest your entire savings in a single stock and it fails, you're in trouble. Spread your investments across different asset classes, sectors, and geographies. Index funds inherently diversify your investments. By investing in an S&P 500 index fund, you're spreading your risk across 500 companies. Create a well-rounded portfolio that can weather any storm. Active versus passive investing is a long-standing debate. Active managers try to beat the market, while passive investors aim to match it. Bogle argued that passive investing is the way to go for most investors. Studies show that most actively managed funds fail to outperform their benchmarks after fees. Bogle believed in the KISS principle: keep it simple, stupid. A simple investment strategy, like investing in low-cost, diversified index funds, is often the most effective. Complexity leads to higher costs, increased risk, and more opportunities for mistakes. Wall Street loves to sell complexity to justify high fees. Stick to the basics. Invest in a diversified portfolio of low-cost index funds, rebalance regularly, and stay the course. Over the long term, the stock market has always gone up. Despite the inevitable ups and downs, the overall trend has been upward, rewarding those who stay the course. Bogle knew that successful investing is about staying invested for the long haul. He emphasized the importance of patience and discipline, understanding that time in the market beats timing the market. The longer your time horizon, the more time your investments have to recover from downturns. Market corrections and bear markets are temporary, but the growth potential over decades is substantial. The best time to start investing was 20 years ago. The power of compounding interest is most effective over long periods. The second best time is today. Starting now allows you to take advantage of future growth and build wealth over time. Don't get discouraged by short-term market fluctuations. These are normal and should be expected as part of the investment journey. Stay focused on your long-term goals and let compounding work its magic. Just like a tree grows from a small seedling into a mighty oak, your investments can grow significantly over time if you remain patient and committed. We're emotional creatures, driven by fear and greed, which can sabotage our investment decisions. Bogle advocated for a disciplined, emotion-free approach based on logic and data. Have a plan and stick to it. Don't let fear or greed dictate your decisions. Tune out the noise and ignore daily market gyrations. Your plan is designed for the long term, not the next 24 hours. Experts making bold market predictions are mostly just guessing. Bogle was skeptical of market predictions because the market is complex and difficult to predict. Instead of trying to predict the market, focus on what you can control: your savings rate, investment costs, and long-term strategy. Time in the market is more important than timing the market. Patience is a virtue in investing. Bogle emphasized that building wealth is a marathon, not a sprint. Focus on your long-term goals and stick to a disciplined investment strategy. Investing is not about getting rich quick. It's about building sustainable wealth over time. Stay focused on your long-term goals and don't let short-term distractions derail your progress. Bogle recognized the importance of bonds in a diversified portfolio. Bonds provide stability, income, and help cushion your portfolio against stock market downturns. The ideal mix of stocks and bonds depends on your age, risk tolerance, and financial goals. Find a balance that allows you to sleep well at night while achieving your long-term objectives. Bonds are the chill part of your portfolio, providing stability and income. There you have it. John Bogle's The Little Book of Common Sense Investing in a nutshell. By embracing simplicity, focusing on low costs, and taking a long-term perspective, you can achieve your financial goals. If you found this video helpful, give it a thumbs up and subscribe for more insightful content. Happy investing!